The most dangerous bubble isn't the one you choose to buy into. It's the one that sneaks into your wallet without asking permission. It doesn't show up with a sign saying, "This is dangerous." It shows up with nice names. Innovation, growth, technology, diversification, future. And before you know it, some of your money might be funding a story you might never have bought into if you had understood what was behind it. This is the point that almost no one explains. Modern bubbles don't need to convince you to open the brokerage app and press the buy button. They just need to go to the place where their money automatically goes. In your retirement fund, not your ETF, in your index fund. In your monthly contribution plan, in that little box you chose years ago because it seemed safe, simple, and smart. And perhaps she is all of that, but safe doesn't mean invisible. Simple doesn't mean risk-free. Automatic doesn't mean that no one is making decisions for you. So the central question of this video is simple. What if the next bubble doesn't enter your life through a risky bet, but through a safe account that you almost never check? If you want to understand finance without the fog of Wall Street, subscribe to the channel. Here we talk about why crises happen and why smart people keep getting caught in them without realizing it. Now, consider the average investor. He works, he receives his salary, it contributes to retirement. Buy a large fund, perhaps a tech ETF, perhaps a growth fund, perhaps a target date fund, one that promises to adjust risk according to age. He's not trying to be greedy. He's not trying to bet everything on a trendy stock. In his mind, he's doing the right thing. He is being responsible. He's not thinking about the future. But the problem begins when this future is sold in packaging that seems rational, but carries an emotional narrative. Because every bubble starts like this. At first, it doesn't seem crazy. It seems like an opportunity. It feels like a new era. It seems that those who doubt simply haven't understood. That's how it was in the dot-com bubble. That's how it was in the real estate market before 2008. This has been the case at various points in the history of cryptocurrencies. That's how it was with meme stocks. And it could happen again with artificial intelligence, giant private companies, billion-dollar IPOs, private credit, real estate, technology, or any other topic big enough to capture the collective imagination. The most confusing part is that, often, the story behind the bubble is true. Internet era real. Smartphones were real. Crypto had a real idea. Artificial intelligence could become a reality. Space companies can build amazing things. The mistake is not believing that a technology can change the world. The mistake is forgetting that a good story can still turn into a terrible investment when the price becomes disconnected from reality. A bubble isn't born solely from lies. Often, it stems from a truth taken too far. First, the story convinces people. Then, the price confirms the story. Then the media amplifies it. Then the funds come in. Then, those who were left out feel ashamed for not participating. And in the end, many people don't buy because they understood. Buy it because you feel you can't be left out. That's where behavioral economics intersects with financial crisis. It's not just about numbers, it's about fear. Fear of losing money, fear of being left behind, fear of being the only idiot outside the party, fear of discovering that your retirement savings are buying something you would never choose on your own. The fear is that the market won't collapse all at once, but that the standard of living for ordinary people will be slowly crushed. And perhaps that's the scariest part, because, for many people, the crash no longer seems like just a drop in the graph. It seems like a more expensive rent, more expensive food, more expensive debt, more unstable job. Retirement is further away, and a stock market that keeps rising while real life gets tougher. So when someone asks, "Am I exposed without knowing it?" That's not a paranoid question, it's a practical question. Because today you might think you've bought diversification, but in reality you've bought multiple versions of the same narrative: technology, growth, low interest rates, artificial intelligence, large companies. The promise that the future will be so lucrative that any price seems justifiable. And that's the trick. The modern bubble doesn't require you to believe in it passionately. She just needs to be within the structure that receives her money every month. To understand how this happens, we need to look at the three ingredients of every modern bubble: history, behavior, and automatic money. The first ingredient of a modern bubble is history. And that's important because people don't buy numbers. People buy stories. They are buying a version of the future. They buy into the feeling that they are seeing something before most people. They buy into the idea that, this time, the old rules no longer apply. That's why bubbles almost never begin with a phrase like, let's ignore all the fundamentals and pay any price. They begin with much nicer sentences. This technology will change everything. This company is different. This market will never be the same again. Those who understand the future are buying now. And the danger is that some of these statements may be true. The internet has truly changed the world. The problem was thinking that any company with a comma in its name deserved to be worth a fortune. The real estate market really seemed safe to many people. The problem was believing that real estate could never fall significantly. Cryptocurrencies have truly brought a new perspective on money, scarcity, and decentralization. The problem was turning any token with a nosy community into an inevitable revolution. Meme stocks showed that ordinary investors could organize themselves. The problem was confusing collective action with sustainable economic value. Artificial intelligence may be one of the most important technologies of our generation. The problem arises when any company that mentions AI starts being treated as if it were printing money in the future. That's the narrative bias. The human mind loves stories because stories organize chaos. A financial statement is boring. A spreadsheet is cold and impersonal. An investment thesis full of uncertainties requires patience, but a good story is simple. There's a villain, there's a hero. It has a future, it's urgent, some people are getting rich. And there you are, standing at the door, wondering if there's still time to go in. This is where the second trigger comes in. FOMO, the fear of being left out. FOMO doesn't seem irrational while it's happening. That seems prudent. It seems like an adaptation. It sounds like the person is saying to themselves, I don't want to be greedy, but I also don't want to be left behind. That's the emotional trick. When everyone seems to be making money, staying out starts to seem riskier than getting in. The person looks at the neighbor talking about stocks. Look at your colleague talking about crypto. Look at the media talking about the next revolution. Look at your own bottom rising. And suddenly, the fear changes sides. Before, she was afraid of losing money. Now, she's afraid of missing the opportunity. This is a dangerous time. Because when the fear of being left out becomes greater than the fear of being wrong, a person begins to accept prices it would never accept in a normal mental state. She stops asking, how much is this really worth? And he begins to ask himself, what if I never have this chance again? This question is like bubble fuel. This has been the case in many cycles. In the dot-com bubble, the fear was of losing the new internet. During the housing bubble, the fear was that we would never be able to buy a house again. In the crypto world, the fear was of becoming poor while others got rich in a few months. In the meme stock market, the fear was selling before the big movement. In artificial intelligence, the fear might be looking back 10 years from now and thinking, I saw this happen and did nothing. Notice the trap. Fear always uses a real possibility to justify an emotional decision. Perhaps the technology is real. Perhaps the sector will grow. Perhaps some companies will become giants. But that doesn't answer the main question. At what price? Because a bubble isn't necessarily a lie. A bubble is a truth stretched beyond the price it can sustain. And then comes the third trigger, authority. The person thinks like this. If the big banks are involved, it must be serious. If billionaires are buying it, there must be something there. If it's in a well-known ETF, it should be safe. If it's in my retirement fund, someone must have done the analysis. If everyone's talking about it, maybe I'm the only one who doesn't understand. That's the power of social proof. When many people believe in something at the same time, that belief begins to seem like self-evident truth. And when respected institutions participate, doubt begins to look like ignorance. The average investor doesn't need to understand everything to feel secure. He just needs to see grown-ups near the table. Banks, funds, media, analysts, influencers, famous companies, managers using complicated words. Suddenly, the risk seems lower because you're well-dressed. But taking a risk with a suit is still taking a risk. A narrative involving an investment bank is still just a narrative. An expensive asset within a well-known fund can still be expensive. And a bubble within a retirement account doesn't cease to be a bubble just because it came packaged as a long-term strategy. This is the point where behavior becomes a system, because, on its own, narrative bias makes a person pay attention. FOMO makes a person want to go in. Authority makes a person lower their guard. But the bubble really gains momentum when these three triggers encounter a much larger machine, a machine that feels no fear. There is no doubt. Don't ask a question. She just receives the money and buys it, every month, automatically. And that's where individual psychology meets automatic money. Now comes the third ingredient, automatic money. This is the element that makes the modern bubble different. In the past, to enter a bubble, many people needed to choose to buy that thing directly. I needed to hear the story, to get excited, open an account. Press the button. Today, not always. Today, millions of people buy a box. The box is called an index fund. The box is called an ETF. The box is called large cap growth. The box is called technology. The box is called a target date fund. The fund is called a retirement plan. And after you choose the box chooses the companies for you. This is not necessarily a bad thing. In fact, for many people, passive funds were one of the best inventions in the financial market. Lower rates, more diversification, less trying to guess the next winning action, less reliance on expensive managers promising to beat the market and then failing. The problem is not passive investing itself. The problem is when convenience starts to mask concentration. Because you can look at your wallet and think, I am diverse. But when you open it up, you discover that several funds have the same companies, the same sector, the same narrative, the same risk. You have an index fund, a technology ETF, a growth fund, a retirement fund, perhaps even some individual actions. And they may all be revolving around the same idea. Large American companies, technology, artificial intelligence, liquidity, future growth, and the confidence that the market will always find a more optimistic beer after you. The packaging looks different, but the filling can be similar. It's like thinking you ordered 5 different dishes at a restaurant, but they all came with the same sauce. And if that sauce goes bad, it doesn't matter how many dishes you ordered. This is where the average investor gets confused. He didn't buy a specific stock, he bought a category. He didn't say, I want to finance this company at this price. He said, put a portion of my salary into something ample and secure. And the system did the rest. Every month, the money comes in. From salary to 401k. From 401k to the bottom ... from the bottom to the index. From the index to the companies that are part of it. No drama, no headline, no raid button. It's just an automatic transfer that seems too small to worry anyone. But when millions of people do it at the same time, it becomes a river of money. And rivers don't ask if the landscape makes sense. They follow the path that was designed for them. That's the power of passive flows. If a company is included in a major index, many funds that track that index need to buy. Not because the company is cheap ... not because the price is fair. Not because the small investor read the report, but because that's the rule. And when a rule dictates that a lot of money needs to be spent on something, the price can go up before most people understand why. It is at this point that the bubble ceases to depend solely on individual excitement. It begins to be fed by financial piping. The investor sees the price rising and thinks, perhaps the market knows something. But some of that high spirits may not be wisdom. It could be mechanical, it could be flow. It could be a fund buying because it needs to track an index. It could be a manager buying because they don't want to fall behind the benchmark. Benchmark is the standard of comparison. If a manager is compared to an index, and that index is full of technology stocks, they may feel pressured to buy technology stocks as well. Even though I was suspicious of the price. Because if he stays out and the market continues to rise, he seems incompetent. If he goes in and falls along with everyone else, it just seems like collective bad luck. This is one of the most dangerous ironies in the market. Doing what everyone else does might be risky, but it looks professional. Doing things differently might be prudent, but it seems foolish while the bubble is rising. That's why the question, is my 401k automatically buying this, is so relevant, because she changes the problem. It's no longer about one person being greedy. It's about a responsible person trying to save for the future and discovering that some of the risk has been outsourced to a structure they don't oversee. And the structure doesn't know you're afraid. You don't know that you're close to retirement. Don't you realize that you don't understand that company? You don't know that you wouldn't accept that price if you had analyzed it calmly. She just follows the rules. The modern bubble doesn't need your belief. She just needs her contribution schedule. If you ask a simple question, they say you're rooting against them. If you talk about profit, they say that profit is a thing of the past. If you talk about risk, they reply that the risk is already priced in. This is one of the clearest signs of euphoria. Doubt turns into offense, skepticism turns into envy, and the analysis turns into a fight between those who understood and those who were left behind. This has happened before. During the dot-com bubble, it wasn't enough to ask if the company had real revenue. The answer was always about the size of its future. In the real estate market before 2008, it wasn't enough to ask if people could afford their mortgages. The answer was always that properties weren't falling into disrepair across the entire country. In the cryptocurrency market, it wasn't enough to ask where the cash flow would come from. The answer was that the old financial system was dead. In meme stocks, it wasn't enough to ask what the company was worth. The answer was that those who sold would be crushed. And with any new tech craze, the response is usually similar. You're thinking small. This is how the bubble protects its own narrative. She turns basic questions into evidence of ignorance. But a basic question doesn't cease to be important just because it's become inconvenient. How much cash does this generate? How much does it need to grow to justify that price? Who is selling it? Who is buying? Who needs me to come in now? Who gains liquidity if I buy? These questions may seem too simple for Wall Street, but that's precisely why they matter. Because when an investment needs 50 slides to avoid a simple question, perhaps the simple question is the problem. Another sign appears when profit is replaced by potential market. The conversation shifts from what the company earns today to the size of the world it can dominate tomorrow. The total market is gigantic. This is a historic opportunity. Technology is inevitable. The company is only at the beginning. All of this could be true. But there's a huge difference between a great opportunity and a fair price. If the future needs to be perfect for the investment to make sense, you're not just buying a company. You are buying a story with no room for error. And bubbles love stories with no room for error. Because, while everything is going up, every risk seems irrelevant. Competition, it's already included in the price. High interest rates, it's already included in the price. Profit out of reach, it's already included in the price. Insiders selling, normal, valuation absurd. You don't understand exponential growth until one day the market remembers that nothing was really priced in. I was simply being ignored. If you've ever looked in your wallet and realized you didn't know exactly what was inside, like this video and comment, I need to check, because that's a feeling many people have, but few admit to. Now, here comes the part that needs to be fair. Sometimes, optimists are right about technology. Internet era real. The smartphones were real. Cloud computing was a reality. Artificial intelligence could become a reality. Space infrastructure could become a reality. New models for energy, credit, software, biotechnology, or transportation may become a reality. The problem is that just because something is real doesn't mean that any price makes sense. A great product is not automatically a great investment. An amazing company can be a bad purchase if you pay a price that already assumes 10 years of perfection. A transformative technology can create huge winners while simultaneously destroying investors who got in too late. This is the detail that separates innovation from a bubble. Innovation changes the world. The bubble is changing prices faster than the world can keep up. The problem with bubbles isn't that everything is fake. The problem is that something real ends up being priced as if nothing could go wrong. And when nothing can go wrong, it only takes one small thing to go wrong for the whole castle to tremble. Growth is slowing down a bit. Money becomes more expensive. The investor is losing patience. An insider sells more than expected. A competitor appears. A metric that was previously ignored is starting to matter. And suddenly, what used to be called long-term vision starts to be called excess. The entrance was enormous. Everyone wanted to participate. Funds were coming in, influencers were talking. The media amplified it, ordinary investors felt left behind. That the exit door is usually smaller, much smaller. Because everyone is willing to wait when going uphill. During a downturn, everyone discovers that liquidity is also a behavioral issue. When fear arises, people don't want to understand, they want to leave. And if too many people try to leave at the same time, the price becomes the only thing that can create space. So the most important question isn't when will this break? Almost no one can answer this question correctly. The better question is, how do you behave before you find out? You don't try to predict the exact day of the crash. You don't sell everything in a panic. You don't buy everything out of FOMO. You don't turn a video, a chart, or a headline into a financial plan. This isn't personalized financial advice. It's a mental framework for not letting the market think for you. Because the biggest advantage for the average investor isn't knowing exactly when a bubble will burst. It's recognizing when your own behavior is being pulled inward toward that. The first step is simple. Know what you have. This seems obvious, but many people don't know it. The person says, I invest in the market. But when you ask which companies, sectors, or topics she's involved with, the answer is silence. She has a 401k. There is an IRA. I have an ETF. It has a target date fund. It may have a technological background, perhaps some individual actions, but he never opened the wallet from the inside. And that's the problem. You don't need to decorate every company. But you need to understand the highest concentrations. What are the 10 largest assets in your fund? How much of your portfolio is invested in technology? How much is invested in artificial intelligence? How much is it in mega caps? How much does it depend on the same growth narrative? Because sometimes the risk isn't concentrated in a single position, it's in the invisible repetition. You think you have 5 different investments, but they're all betting on the same future. The second step is to check for overlap. Overlapping occurs when multiple funds that appear different are holding the same companies. A broad-based ETF can hold the same tech giants as a growth fund. A retirement fund can carry the same index as another product in your portfolio. An individual stock that you bought separately may already be held within several funds you own. So, without realizing it, you might be saying the same thing 5 times. I believe that this small group of companies will continue to drive the market. Perhaps that will happen. Maybe not. But you need to know that you're making this bet. The third step is to separate 2 phrases that many people confuse. I believe in that future, and I accept paying this price. These sentences are not the same. You can believe in artificial intelligence and still find some stocks expensive. You can like a company, but not like its valuation. You can find a revolutionary technology and still decide to wait. You can recognize that a company is excellent and still admit that the market has already priced in too much perfection. Investing isn't about voting on which future looks better. It's a question of how much of that future has already been claimed today. The fourth step is to be wary of the urgency. Every bubble has an imaginary clock. Enter now, you're going to lose. This time it's different. The market will never give us this chance again. Urgency is one of the most effective tools for shutting down critical thinking. When you feel you need to make a quick decision, perhaps that's exactly the time to slow down. A good financial decision can survive a night's sleep. A sound argument shouldn't depend on panic. The fifth step is to be wary of IPO euphoria. An IPO is not a gift from the market to you. It's a sale. Someone is putting a company on the market because they want to raise money, create liquidity, or allow existing investors an exit strategy some point. This doesn't mean that all IPOs are bad. It means you need to ask, who is selling it? Who is buying? Who needs me to believe this story? Who gains liquidity if the public comes in? So what needs to go right for that price to make sense? The sixth step is to look at incentives. The financial market is not just about numbers. It's an incentive. Banks profit from issuing currency. Managers make money by keeping money under management. Companies win by selling the right narrative. Insiders can profit when there is sufficient demand to absorb their shares. Media attention is being gained. Influencers are getting clicks, and you win if you understand the game before becoming a pawn in it. The seventh step is to create rules before panic sets in. Because when the market falls, you don't become a more rational person. You become a more emotional person, so the rules need to exist beforehand. How much risk are you willing to take? When do you rebalance? Rebalancing means adjusting your portfolio to return to its planned weight. What would make you admit you were wrong? What is the maximum percentage of your portfolio that can be allocated to a single narrative? Do you buy because you understand, or because you're afraid of missing out? These questions do not eliminate risk, but they reduce impulsive decisions. And that already puts you ahead of a lot of people. Because the bubble machine doesn't need to control your account. She just needs to control her behavior. She needs you to confuse popularity with security. You need to confuse a rising price with proof. You need to confuse a real technology with an automatically good investment. It needs you to buy when you're in a hurry and sell when you're afraid. This is how the average investor turns liquidity into something more profitable for someone who is better prepared. Not because he's stupid, but that's because he enters the game without knowing what game he's playing. The solution is not to live in fear. The solution is clarity. Clarity about what you possess. Clarity about what is expensive. Clarity about which narratives dominate your portfolio. Clarity about which decisions you actually made and which decisions were made automatically by a box called the background. The biggest advantage for the average investor is not predicting the next crisis. It's about not surrendering your behavior to the machine that creates crises. You don't need to predict the bubble, you just need to stop letting the bubble make decisions for you. Comment on an investment you have but don't fully understand yet. Like the video if it helped you see how the market works. And watch the video that's currently playing on the screen, because in it I show the signs that people usually ignore before a crisis.